Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am going to talk to Jason Stubblefield today. He has been investing in real estate for over 10 years. He's in one of my favorite market, Atlanta, Georgia. So we are talking about Atlanta. He started with single family homes like most of us, right? That's where we start. We learn baby steps. And then he moved into the multifamily or apartment space. He scaled his portfolio to over 1,000 units in just a few years. Jason grew up in a lower class family and was always mindful of the tenants that he served. That concern led him to transition his company into the affordable housing space. And all of us know right now in America, the biggest problem we have is the affordability, right? So we want to peel the onions today and talk about how he wants to solve this affordable housing crisis. So welcome, Jason.
Thank you, Alpesh. I'm glad to be a part of it. Thanks for the invite.
Absolutely. So we always start with this question. Tell us something funny or interesting about yourself.
Yeah. So I got butt naked in Cancun. It was it was years ago before I was married or anything, but I was young and there was nude people on the beach, and I was fascinated about that. I was like, oh, so you could just do this? This is legal here? And I just, I had maybe 1 too many tequilas and I just went for it. So
yeah, you are in Cancun, right?
Yeah,
So how did you get started with real estate? What was your first foray into investment side?
Yeah, like a lot of your listeners, it was the reading of Rich Dad Poor Dad, and then that got me started. And I was like, all right, well, I understand what I have to do now if I want to better my life. And so that's what got me started. I started with a single family home, and the term wasn't out yet, but it was house hacking. I had done that because I was living in the Washington, D.C. area, which is pretty expensive.
Right.
And I was renting rooms out. And so I wanted to transition to be a person who actually owned the property and was renting the room. So that was the first deal.
Oh, that's awesome. And how did it work out for you?
It went great. I was fortunate enough to be able to buy at a great time. It was shortly after the great housing financial global financial crisis. And so after that, prices were low. So I was able to get in a decent value.
Well, that's great. So that was your first investment. And did you sell that one?
I kept it for a while. So
okay.
I actually lived there for only a few months. And then I bought another investment property. And after that, I got married shortly after that. So then we bought a property that we lived in together. So that was all around a span of about 9 months, I guess, between that first property purchase and those 3 purchases.
So what kind of assets do you own right now and why?
Yeah, so it was a period of time after that where I no longer could afford a down payment, right? I was growing my family at the time. And so I didn't have any money, and I just sat on the sidelines for years. And it wasn't until later on that I was like, hey, I need to start building wealth. And that's what led me back to getting into real estate. When I did so, I sort of did the math and actually calculated how many of these single family homes do I need? And once I did the math on that, I was like, ooh, we got a problem, because it was going to take me, I needed, I don't know what it was, 10, 15 homes that all were going to give me X amount of dollars.
Oh, and when I calculated, I had like 90 homes. I'm like, okay, it's going to take me 4 homes a year, maybe.
Yeah. You really start to see how far-fetched it can be depending on where you are. And I saw that gap too. So that's what led me to look for other things. Like this real estate thing isn't going to work. But eventually it led me to apartment buildings. And once I started investigating that, I was like, okay, I can cut down this single family the single family model that's going to take me years or decades, right? And I could sort of bring that into something more reasonable, like maybe 3 years, 5 years or so. So that's what got me started into apartments.
Got it. So let's talk about affordable housing. What do you mean by affordable housing?
Yeah, that's a term that's got a lot of it's got a lot of different
Yeah, everyone
meaning.
talks about
They
it.
say it, right? But I think the official term is affordability is that it's not costing the renter more than 30% of their income. I think that's the proper definition. But you also have people who will say like workforce housing, and maybe that's
Right.
like I could be wrong on this. Maybe that's 80% of the area median income that people earn. But when I say affordable housing, it's talking about the programs that the government has where they try to keep that affordability to the tenants. And so the criteria for them to do that is usually they have the area median income, and then it's a certain percentage of that income that they call affordable. So it could be 80% of the area median income, it could be 60%, and it goes all the way down to extremely low poverty levels as far as just affordable housing.
That makes sense. So in which areas are you or markets are you focused on?
I'm focused on the 60% area median income. And if you're talking about location, it's
Location.
primarily in Georgia and
Okay.
Tennessee for right now. Yeah, those are locations.
Georgia
And
and
then within
Tennessee.
that affordability, we tend to go, I mean, we have some that are maybe down as far as 50% area median income, and
Okay.
we'll go up to maybe 80.
Oh, okay. Makes sense. So yeah, because I'm also, I moved on from single family to apartment and now mostly mobile home parks because of affordability, right? I
Yep.
think we got to provide a nice place to live, and mobile home park is one of those places as well where, you can provide affordability. So, no, I agree with everything you have said so far. But how do you plan to help solve this crisis?
Yes. So affordable housing is really like a public-private partnership. And so with these projects, as you know, in market rate developments, you have capital, equity, and it's all looking for yield, right? They want a
Right.
return on that investment. And it's very hard to either build new construction or maintain properties without damaging the affordability component of them. So you say you want to go out and just buy a C-class property, B-class property, talking about apartment buildings. Most investors are going to take that and see how far they can take rents by the market. It's market conditions. And because we have a supply demand issue, oftentimes owners can charge 40% of what tenants are making, 50% in
Right.
some cases of what tenants are making, and they have to pay it. And so where I come in with trying to help this is partnering with the government, where
Okay.
they inject some capital into the same property that we're purchasing. And through that public-private partnership, we're able to keep the cost down with attractive lending and equity help and different components like that.
Oh, that's great. And I have not thought about this. So I'm, of course, going to ask you some more questions. So
Sure.
your goal or when you are acquiring a property, are you buying already a class C, class D, class B building, or are you looking to develop with government's help as well?
Yeah. So that's another nuance that's sort of unique to my company, what we're doing. And so there is the affordability component where developers are building from the ground up.
Right.
So
Opportunity
they
zone.
right, but that's not where I'm focused at the
Okay.
time. Maybe we'll get there, but right now, since I already know value add real estate with apartments, and I haven't been doing affordable housing my whole career, this is something that's relatively new. But where I'm focusing at is on already existing affordable housing, and they have a structure that's set up. This structure is set up where the private public partnership, the government and some developer, they partner together for about 15 years and say, we're going to keep this property at these rents for 15 years. After 15 years, that property has several options. It can remain affordable, but there's no longer any sort of what I want to call
Agreement.
obligation.
Oh,
There's no
yeah.
obligation between the developer and the
the
equity
government.
partner. So
Oh,
they can part ways. They could sell the property, whatever they choose to do. So I like to buy those type of assets,
I
maintain the
see.
affordability, but oftentimes there's still value add potential in them because these owners, they're long-term owners. They've owned it for 10, 15 years already. Now
Right.
they're selling it. They probably haven't push rents as much as they could, but those rents are still capped by the
Right.
government. And so that we find the value in that. And then we additionally have the opportunity to partner with the government again. And so that's where it gets really interesting. And so now as the new owner, we can go out to the government and say, hey, we have this property. It's great, right? And we just want to put some more capital into it and keep it for another 15 years or so. So that's what we do. We only buy properties where the deal works, even if we don't have any government intervention. But we also have the added bonus of being able to try to partner with the government and do it again for another 15 years into the future. And that's helpful to the tenants because when the government is doing something, if anybody's working government contracts, they tend to do a good job, but they also throw a lot of capital into it. And so whereas on our commercial market rate deals, we may be doing $6,000, $7,000 a unit, making it nice and appealing. But these projects are, 25,000 per unit is on the low side. So
Oh,
you
really?
probably, you're
Oh,
probably doing
wow.
5,000, 40,000 because Alpesh, like
That's a lot. Wow.
each time they do this, it's a 15-year stretch.
Right.
So they simply look at it, and if any component isn't able to make it for 15 years, they replace it. So it's roofs, it's windows, it's HVACs, it's interiors, it's floors, it's everything. It's everything. So it's a pretty thorough, but the quality of the product, and this is what a lot of people don't realize. Most people think that affordable housing, they think about the ghetto, the clotheslines, all the stuff, but you can actually find properties that are pristine A-class assets that just have rent restriction on them because they have that public.
Yeah, I've seen it where I live actually, and this is like the posh area and whatnot. But I found out that there were a couple of affordable housing properties, and they are like really nice, like as you said,
Yes.
class A, and they can go to the nicest school, and yeah, so I think it makes sense.
Yep.
This is interesting. So when you say partnering with government, does government provide any kind of incentive, any kind of grants, tax credits, or just loan you money?
All of the above. So
Oh, wow.
usually lenders will give you more favorable debt terms.
Okay.
So whereas market rate, you may get 75 or 80% leverage, affordability, granted that there's not any debt service constraints, they may go up to 85 or even some cases 90% of the capital stack. The other equity piece that comes in, that can be through nonprofits, which have a play in this space. And then there's also a lot of other government programs, home loans, CDBG funds that are just out there because they understand that it's an affordability crisis. So when we put a property or a deal together, it's basically seeing what help can we get, right? And you also have equity that comes in the form of tax credit equity. So you also have big players like a Wells Fargo or Bank of America, or even Amazon is getting into it now, where they just have big tax burdens on them. And so they come
want
in
to
and
get those
they
tax
provide
credits.
some equity. Yeah, they provide equity and they get tax credits for doing that. And because of that, we're able to keep rents down. But it's a lot of different moving pieces when it comes to putting the deal together.
And this is not similar to Section 8 where government pays the rent?
No, so there's various programs where we focus at is just on the rental restrictions. But
Okay.
there's also some rental restrictions, meaning like you just don't want to go above a certain level. So
Right,
you can't
right,
make you can't make 150 grand and live in an affordable housing
right,
unit, right? No matter how nice it is or how qualified that tenant
right.
is, right? So it's income restricted. But then
Yes.
there's also some programs that are specific to Section 8, and some of them are just it goes with the tenant. So the tenant gets a voucher. And then you also have some properties that are just set up for Section 8 only. But what's been happening is the government has sort of seen the stigma that comes with that. And so they're
Yes.
doing more mixture, right? So it's sprinkling in some affordable, maybe Section 8, some different, maybe 80% AMI tenants, and then some who may be 60. So it's nice looking properties and then a diverse community when it comes to income levels.
I see. So, when you say income restrictions, I know because you can't be making over 90, 100 grand, whatever. So, on top of the rent restrictions, what does that mean? So, are you below certain market rent, and can you, what percentage can you increase every year?
Yes. So what I guess the best way to explain it would be with an example. So say
Yes.
here in Atlanta, right? Area median income, I'm not sure what it is, but it may be around, call it 70,000 or so.
Mhm.
But our tenants in a 60% AMI property, you can't make above, call it $45,000. Now I could be
Ah,
off if anybody's there. So we were only focused on $45,000. But there's plenty of people. You've got school teachers, you got people who work as police officers, waitresses, whatever, right? They're working, but they aren't making that much money. And so it's providing a good quality asset for them while keeping those rents restricted. So that's how the project works. And so we'll say, all right, every tenant that we rent to now has to go through an income qualification to see if they're approved or not. But if you've been tracking the market, and I'm sure you have, there's plenty of people who fit that criteria. And so what happens is the way it works out economics is that usually there's a higher occupancy rate than normal, right? Because you can fill it up if you operate it correctly because it's in such high
yeah.
demand, especially if you're buying the nicer quality asset.
Yeah, I was actually going to ask you my next question. Is it harder to fill this type of units? But you just answered that it's pretty easy to fill those units.
It's a more difficult application process because you got to
Mm.
verify the income. But as far as demand, it's high demand. There's not nearly enough affordable units for the people that need them.
Hey, this is a funny question. So, because you and I work in single family to multifamily and all, right? When we are going through this tenant qualification, a lot of time they lie, right? But they want to
Yeah,
show more income
yeah,
in
yeah,
most of the cases,
yeah,
right? And then
yeah.
we try to call the employer and whatnot. So, do they lie in this situation where they want to show less income, right, to get in?
That would be, if you're a liar, that's how you allow to get in one of these properties, right? You would lie to say more income for the market rate, but in affordable, you would lie to say less income. It's something that I haven't experienced yet, but because this is so nuanced, we really depend on third-party companies to
Mhm.
handle this, and so they do their income verification
Got it.
process. And of course, there will be somebody who's just good at what they do, or
Right.
maybe they falsify documents. But as long as the property can say that they had these documents verifying the tenant income, they're sort of, they're safe. They're clear. The property didn't do anything wrong.
Got it. And do you have to keep record of everything, or let me ask you this way: do you have to notify government whenever you have a new tenant, somehow, that okay,
No,
we have
it's not
qualified?
that. Yes, it's not that stringent, but they'll do an audit, right? So
Okay,
once a
got it.
year, who lived there, how much money did they make, is it affordable, that sort of thing.
Okay. And my next question is: so you said 15 years. So 15 years is what the government will help you run this property, basically, with the grant or whatever. And then you are on your own, and then you can decide if you wanna partner with government again, or they won't partner with you at all, and you have to sell the property after 15 years.
Yeah, the beautiful thing is, so if anyone is familiar with the syndication process, you have equity
Yeah.
partner, right? And so that
Yeah.
in this scenario, the equity partner is some government entity. Let's just call it Amazon for an example. Amazon is going to get tax credits. And I say that these projects last for 15 years, but the financial aspect of it, or the tax credits, really only last for 10 years.
Got it.
So a company like Amazon, right? They are going to get tax credits for the next 10 years because they put equity into an affordable project. Now, what happens after 10 years is that Amazon sort of goes away and the developer is left with the project. And
Hmm.
so they can then choose to do whatever they want to, which they can oftentimes they sell it on the market because that's a big payday for them. And then they go off and build other projects.
I
So that's
see.
some of the incentive as an operator to it, right? Because if you do this for 10, 15 years, you can end up owning properties, free and clear after a certain period of time.
Yeah, that's crazy. I didn't think about that. So as an operator, this could be very lucrative because your equity partner is pretty much paid off.
Correct.
Wow,
Yeah.
yeah. Wow, that's pretty cool. I had another question and it just slipped my mind, but when you find this kind of properties, or do you start talking to the government first and like this equity partners, or you first find the property and then figure out who all you need to work with?
Yeah, there's more loopholes to jump through, and each government, each state is different. So that's why we're really focusing on Georgia,
Yeah.
because if you go to another state, there's a whole nother set of rules,
Yep.
whole nother set of people to deal with, and you have to navigate through that. So, but to answer your question though, yes, you have to understand the rules in that specific state, what's required, and then you have to meet their requirements upon takeover. So a lot of guys who go out and they see these deals, they have a strategy where they just buy the tax credits at the end of the compliance period, and then they take it to market rate and they do well. That's a great value add. But what we do is try to partner with the government to say, hey, we want to keep running this thing as an affordable project, but we still have enough value add potential within it.
I see. And so after 50, so you are buying this from someone who has already gone through 15 years. And when you acquire, you said you end up spending maybe 30, 40,000 per unit. Um, are you able to increase that rent that first year itself? Because you are
Yes, yes.
spending so
So
much money and then you're not going to keep the rent as, where that guy left. Right?
right, right. So it is government controlled, but it works out because they sort of monitor things. So like last year, we have an inflation problem right now. And so
Huge.
last year, because of that, rents, I want to say they went up double digit percentage
Yes.
wise
Yes.
across the board. And so that leaves a big delta in just value potential. But each year it's regulated by HUD. They'll come out and it may be 3%, it may be 5%. It's very much in line with how a conservative pro forma would look, right? You're going to underwrite maybe 3% rent bumps a year. It's very similar to that. You're just getting that percentage from the government instead of you coming up with it yourself.
I see. So let's talk about due diligence process for this kind of project. What is your due diligence process?
Much of it is the same as everything you do with apartments. So it's inspecting the roofs, inspecting the plumbing, walking all the units, bringing out inspectors, electrical, that whole thing. But in addition to that, you also want to be very concerned with the rent restrictions and all those government documents that are associated with it. So all these properties come with a LURA agreement, which is a land use restriction agreement, which sort of details what you can and cannot do. And they may also have other projects or programs that are associated with the project. So part of the due diligence is understanding what those are and making sure that you understand how you're going to comply with all of those. So the underwriting gets a little bit more intensive as you have to research what you can do. And then also you need to know the qualifications for that state. So you don't want to go out and try to buy a deal and then you go into the state and try to say, hey, I want to buy this, and they deny you. So, understanding that is part of the due diligence as well.
Yeah, and actually my next question is how do you underwrite this type of deals? Like, because in typical multifamily deal, we already know these are the line items, right? But you have now different line items, government incentives to tax credits and whatnot. So how do you underwrite this type of deals?
Yeah, there is the way we approach it is a two-pronged approach. One of them is your standard market rate because we buy deals with the understanding that we may not be able to work with the government. And we don't
Ah,
want to get into a situation where we can't work with the government and now we bought a bad deal. So
yes.
we just underwrite it like your typical deal. The only difference is the rent restrictions. Where are the rents? Where can we take them to within the rental restrictions? So that's one underwriting. Then additionally, we have a second underwriting model that is all about tax credits and working with government agencies, and it's very similar far as the numbers to go. The only difference is the the different costs associated with working with that government. And I'll be honest, we just look for professionals who have a good reputation who've been doing this. So
Yes,
I
of
had
course.
a underwriting model, and then I give it to a tax credit professional, and they say, yeah, in this state, in Georgia, this cost is going to be this cost, you're going to need that, you don't need this. And then we use that as a basis. But because the numbers are so big, we do deals where there's plenty of wiggle room. So maybe we need an extra 100 grand of attorney fees or something, right? And that can happen in these deals, but we sort of underwrite that with a lot of buffer.
Makes sense. So, in how many of this type of deals have you done so
So
far?
we are in contract on our first, and
Oh,
then we
okay.
are also best and final on another right now. So we're very new with sort of
Got it.
moving over, but the last year was all about just learning this process, how
Right.
all this stuff works, and then trying to figure out. And now that we got it, it's go time, and it's pretty fun.
No, that's good. So, do you mind sharing with us? You don't have to share the location or whatnot for the property you are under contract, but if you can share with us, numbers, right? What price you are paying, what rent you may be commanding, and were you able to partner with government on this one, and if you are able to get any tax credits.
Yeah, so here's the thing that's probably gonna floor a lot of people is even in Atlanta, we have one property under contract at 70,000 a unit,
Mm-hmm.
which is unheard of.
Right, it's
The
impossible.
other one where we are best and final on is around 65,000
Oh
a unit.
wow.
And these assets, I mean, if you saw them, you'd be like, wow, that's a very nice asset. I can't believe that you're getting it for that price. So it's very comforting, I guess, to say like, all right, we didn't pay too much. Now, granted, it's based off of net operating income, but
Correct.
where there is a supply demand issue or hot multifamily market, by niching down, we're able to find other deals because there's not of developers or syndicators that are looking for these types of deals. So instead of maybe 20 people bidding on a project, we may only have to deal with 5 or 10.
Got it. And what about were you able to get the government in partnership going as well as the tax credits on this property which is under contract?
So the first, it already has that government partnership with it. So the first thing is for us to just buy it. And I know you asked about returns too. So our returns look just as good, if not better, than any market rate deal. So if anybody's participating, you're probably looking 6 to 8% cash on cash, and call it 14 plus IRR, something like that. So we target those too, and even try to make those deals better than that. And that's how it looks. But the first thing is just buying it and owning it. And then after we own it, then we have the opportunity to say, hey, let's go in and see if we can partner with the government again.
I see. And what about tax credits? Are you already working to get some tax credits or with a major company or whatnot?
So the pieces are in place, right? Because you want to work with a reliable company that's done this world before, that's played a part, that's gotten applications accepted. So the process is working with the government. You have to put in an application, then they accept it, and if they accept it, then you take the next steps. So our first step is just to buy it, and then we go in for the application. We put that in, and then we see what happens from there.
Got it. And how do you find uh, this businesses like Wells Fargo and Amazon who would want to be an equity partner? Do you also work with a professional who has relationship with those businesses?
Yeah, so they do have tax credit consultants, counsel, people who represent them, and going to affordable housing conferences or affordable housing meetings is where you find connections with people who do that. They also have brokers, just like a broker may go out and try to find you a mortgage or something like that, or insurance broker. There are also brokers who know other equities that are or partners who are looking for tax credits, and so that's how those partnerships are established.
Oh, this is awesome. Is there anything else you would like to add, or if I missed anything?
No, I think you did a great job of asking questions. I know that it's a lot of new information, but
Yes.
I hate that it's this complicated to explain. But the the goal behind it, once you jump through all these hoops to get a deal done, is that not only can you do well, but you can also do good, so you can make a
Yes.
lot of money as a passive investor or as an investor, and you can also provide very necessary housing for people who need it and give them, as you mentioned, some nice quality places that they can stay at an affordable price.
No, kudos to you for figuring this out, because this is what I call it as impact investing. We of course
Yeah,
want to
exactly.
make money, but we also want to do good while we are making money.
Yes, yep,
Oh,
exactly.
so I appreciate that. So thank you so much for your time. And if you're ready, let's go to fire round.
Let's do it.
Would you be changing any business or investment strategy because of inflation or recession? Because I know
No.
one of that is coming, right? Or it's
No.
there. Okay.
And the reason I say no is because we buy for cash flow. But granted, there are going to be some changes in that. The overall project that we buy is cash flow because we don't know what's going to happen. Rates could continue to accelerate and just go higher. But if you have a cash flowing asset, you're not really worried about that. True, your evaluation will drop down, but we just have to hold it. And right now, we've got a good place to do that. So that's it. And obviously, the strategy of doing bridge debt and floating rates is something that we're shying away from as well.
Okay. No, that makes sense right now.
Yeah.
Favorite real estate or finance or maybe business related book?
I would have to say probably one that you've heard a lot, which would be Rich Dad, Poor Dad. That's the one that comes
Yeah.
to mind. I yeah, I'll stick with that.
Yeah. No, I would say about 70% of my guests have the same recommendation.
Yeah.
Any tool or website you recommend or you cannot live without?
Justicemap.org.
Justicemap.org. Okay, I have
Yes.
not tried that one. Okay, I got to check
Yeah,
that out.
it's a great website. It breaks down throughout like the street level, income levels. And so as you may know, you can be in a major city and one side of the street is making 70 grand a year and another side of the street is making 40 grand. And so Justice Maps allows us to really pinpoint what that block even is doing. And it's a free tool and it's super valuable to us.
Yeah, no, I'm looking at it now. It looks cool.
Yep.
Any advice for beginner investors?
Yeah, believe in yourself and then surround yourself with people who are doing what you want to do.
That's a great advice. How do you give back?
Yeah, so giving back, I believe in tithing, right? So we take 10% of what we earn and we give it. And it's not necessarily to a church, but we look for people who I feel obligated. If someone contributes to my life, that I usually look to pour back in. And so we try to give back some of what we take in. And that's just a philosophy that I have in life and business.
Oh, that's awesome. Thank you so much for your time, man. I really had fun.
Yeah, me too, Alvesh.
Yeah.
Appreciate you having me.
And before I forget, how can my listeners reach out to you?
Yeah, so the best way is that I'm sharing a lot of information about whether it be affordability projects we're doing and just learning about multifamily in general. And that's in a Facebook group. The Facebook group name is called The Multifamily Code. So you put it there, you join up and start going through materials.
Thank you so much again, man. Have a good one.
Yeah, you too. Appreciate it.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, Please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!